Have you ever noticed something that feels almost ridiculous? Central banks keep saying they are printing money, yet the cash in our wallets does not magically increase. They say they are shrinking their balance sheets, yet no bank shows up at your door asking for money back. So where does that money go? Why is it that the moment the news says QE, stocks jump, and the moment it says QT, global assets start shaking? And here is the weirdest part. Sometimes the central bank floods the system with liquidity, and long-term yields still rise. How does that make any sense? Today we are going to break the window open and make QE and QT feel obvious. In the last episode we talked about interest rates, and we agreed on the basic idea that rates are the time price of money, and they are the central bank's core tool for setting the pace of the economy. But if you have been watching more professional commentary lately, you have probably noticed something. People who actually live inside markets are no longer obsessed with just how many basis points the next hike will be. They care more about one signal that captures deep expectations, and that signal is the inverted yield curve. So why does a small move in the 2-year and the 10-year U.S. Treasury yield make global markets hold their breath? Why are the Fed and the ECB adjusting policy rates while also running QE and QT through their balance sheets? Today we start with rates, then we go one layer deeper into the structure of how markets are wired. I will also share a case study that is especially useful if you live in Europe, which is how Hungary in 2022 walked a tightrope between high inflation and currency stability. Over the next 10 minutes we are going to map the deeper plumbing of global capital flows. Let's do a quick refresh. In normal times, the longer you lend money, the more uncertainty you take, so long-term interest rates should be higher than short-term rates. But when an inversion happens, the picture flips. Short-term borrowing becomes more expensive than what the market expects to earn over the long run. Think of an inversion as a forward warning signal. It is not describing the present, it is hinting at what the market sees ahead. It is like driving and noticing the brake lights in front of you. You are not crashing right now, but you should move your foot closer to the brake because the road ahead may be slowing down. Under the surface, an inversion usually reflects two simultaneous judgments. The short end, especially the 2-year, is tied closely to near-term central bank policy. When the central bank hikes quickly, the price of borrowing right now rises fast, so 2-year yields jump. The long end, like the 10-year, is more like a vote on the future. If investors are not confident about long-term growth, they shift toward long-dated government bonds for safety. When more money piles into long bonds, their prices rise, and their yields get pushed down. When those two forces happen at the same time, the curve inverts. Historically, inversions have often appeared when the economy is approaching a turning point in the cycle. If you look at Europe, German government bonds are the anchor of the euro area. Changes in the Bund yield curve are not just a German story, they are a signal about euro area growth expectations. If the Bund curve inverts too, that is a sign the euro area's core engine is losing speed, and risk pricing across the region tends to reset. Last episode we said the central bank mainly uses rate hikes and rate cuts to influence short-term rates and steer the economy, but there is a hard constraint, which is the zero lower bound. You can think of the traditional toolkit like turning a faucet. Hiking tightens the faucet, cutting loosens it, but once the faucet is fully open and rates are near zero, it is hard to loosen further, so what happens next? That is where QE and QT gave central banks a more direct tool. The central bank can step into the bond market and buy government bonds, and by pushing bond prices up it pushes long-term yields down. At that point the central bank is using two toolkits at once. One is the price tool, which is the policy rate. The other is the quantity tool, which is the size of the balance sheet. Let me show you what that looks like on a chart. If you want to see QE with your own eyes, don't start with headlines, start with the Fed's balance sheet. Before 2008 it's basically flat, then the financial crisis hits and the line jumps, that's the first true QE wave. The same thing happens in 2020, another near vertical surge, so here's the simple translation: when the system is in trouble the Fed doesn't just cut rates, it expands its balance sheet and pushes liquidity straight into the plumbing. Now look at Europe, the ECB's balance sheet tells the same story, but with a very European twist. You see the build-up after the global crisis, then another huge expansion during COVID, and in Europe this wasn't just stimulus, it was also stabilization. When spreads were blowing out and the market was questioning the euro project itself, balance sheet policy became the backstop, and in plain English QE is the forward drip. Central banks create new money to buy bonds, that cash lands inside the financial system, and suddenly there's more liquidity sloshing around. Do it too hard for too long and markets swell, valuations lift, and bubbles get easier to form. Now switch to a trader's point of view. Imagine you manage billions and you are watching the data deteriorate. The central bank may still sound tough in public, but you believe they will not be able to hold that line for long, and you expect cuts later. So you try to get ahead of everyone and buy long-term government bonds now, because you are betting that by the time the crowd wakes up, long-term yields will already be lower. When thousands of traders make that same move, long-term yields can get bought down. This is one reason inversions form. An inversion is not just economists predicting a downturn, it is traders placing real money on a future path. In 2008, Ben Bernanke was at a crossroads. The policy rate was already near zero and the economy was still sliding. The Fed did something it had never done at that scale and started buying treasury bonds to inject liquidity. Bernanke later said he could barely sleep that night because he did not know whether this was a life-saving medicine or a Pandora's box. Looking back, the answer is that it was both, and both effects showed up. In Europe, QE also carries a stronger financial stability role. During the 2011 euro area debt crisis, yields in parts of southern Europe surged, and markets seriously questioned whether the euro area could fracture. Mario Draghi said he would do whatever it takes to defend the euro, and the ECB followed with large-scale bond purchases that compressed spreads between member states. That episode shows something important. In Europe, QE is not only an economic stimulus tool, it is also a safety valve that aims to prevent local funding stress from becoming systemic risk. When QE is running, liquidity tends to spill over, and the first assets to get re-rated are usually the highest quality ones. If you understand that, it becomes easier to judge where money is likely to flow in different phases of the cycle. But if all we say is that liquidity spills over, we still miss the core mechanism. Imagine an extreme case where the central bank announces it will buy 10-year government bonds in unlimited size for the next decade. The first-order effect is simple: the supply of long bonds available to the market shrinks, bond prices rise, and long-term yields fall. What matters even more is that a long-term yield is not a single number. It is built from two layers: the market's expectation for future short-term policy rates, and a term premium, which is the extra return investors demand for locking money up for 10 years instead of one. When QE is running, the central bank often compresses that term premium, and that shifts the long-run discount rate, which is why valuations in equities, credit, and real assets can re-rate even if the growth outlook does not suddenly improve. This is the real way QE moves markets. For policy responses, there is a very instructive case study in Hungary. If you lived in Europe, 2022 was hard to forget, and for countries outside the euro area, the currency pressure was more direct and more intense. When the main reserve currency, especially the US dollar, enters a hiking cycle, emerging market currencies often face depreciation pressure. Hungary's central bank had to prevent the forint from sliding too fast, because a sharp currency move makes imports more expensive and pushes up imported inflation. That meant the central bank needed to look more aggressive on rates than larger, safer economies. To stabilize expectations and slow capital outflows, Hungary pushed its policy rate into double digits and also used a very high overnight rate to pull liquidity out of the system. The message to the market was that policy would stay tight enough, for long enough, until expectations settled. The deeper lesson is that when the global monetary cycle turns, local asset pricing can be pulled by global liquidity more than people expect. If you live in Europe, the euro area is structurally more stable, but shocks from nearby markets can still spill over, and it matters to understand that transmission chain. So what is QE? Think of the central bank as the biggest player in the bond market. When it stops buying bonds, lets maturing bonds roll off without reinvesting, or gradually reduces its holdings, the market sees lower demand and higher effective supply. bond prices tend to soften, and yields tend to rise. Another way to remember it is this. Rate hikes slow the speed of new money entering the system. QT pulls water out of the pool. When you combine the two, tightening feels much stronger. When inflation rises, policy often moves into a repair phase, and QT is about shrinking the balance sheet toward a more normal size. The central bank can do that by letting bonds mature without reinvesting, or by selling small amounts, so liquidity is slowly withdrawn. QT is not only about having less liquidity. When the central bank stops reinvesting and the market has to absorb more long-dated bond supply, the term premium can rise, long-term yields can drift higher, and the discount rate moves up. That is when assets that were priced on cheap liquidity face a faster repricing, especially long-duration growth stocks. At that stage, cheap money becomes less available. Assets that were priced with a liquidity premium have to face a valuation test. At the same time, when the US tightens, global capital flows often shift. For Europe, that can mean larger currency swings, which then affects import costs for essentials such as energy. This is one reason Europe faces external challenges when US and European policy cycles are out of sync. After you understand rate hikes and cuts, and QE and QT, you can build a simple framework. Central banks have two toolkits. One is the price toolkit, hikes and cuts, which decides whether borrowing is expensive or cheap. The other is the quantity toolkit, QE and QT, which decides whether there is more money or less money moving through the system. We often treat hiking as tightening and cutting as easing, but when you combine both toolkits, you get 4 different policy postures. The first is hikes plus QT. This is the strongest tightening mix because borrowing becomes more expensive and liquidity is pulled out at the same time. The signal is clear: fight inflation and cool an overheated economy, and this was the Fed's typical mix from 2022 to 2023. The second is cuts plus QE. This is the strongest easing mix because borrowing becomes cheaper and liquidity is injected into the system. The signal is also clear: backstop the economy during a crisis, and this is what the Fed used in 2008 and again in 2020. The third is cuts plus QT. This mix can confuse markets because the central bank is easing the price of money while tightening the quantity of money. Unless communication is extremely clear, this posture is difficult to sustain because it sends signals in opposite directions. If you connect the pieces, you can see that the central bank is not only changing the amount of liquidity in the system, it is also moving the pricing benchmark for long-term assets. When that benchmark is lower, risk assets can lift more easily, and when it resets higher, valuations have to adjust. The fourth is hikes plus QE. This looks the most contradictory, but it has happened. It is usually not about broad stimulus, it is about repairing a specific market function. For example, when the repo market was stressed in 2019, the Fed used liquidity injections at certain points to keep funding markets functioning. The goal was to fix the plumbing so trading could continue normally. Now you can see why markets sometimes look chaotic. If you only watch hikes and cuts, you may conclude the central bank is tightening, but if the balance sheet is expanding at the same time, liquidity is still being added. When the direction of these signals is not aligned, markets struggle to decide which one matters more. This is why professionals do not watch only the policy rate and they do not watch only QE or QT. They watch both together, because the real message is in the combination. Many people only watch the headline terms, hike or cut, QE or QT, but markets do not react to vocabulary, they react to what those actions do. Is money becoming more expensive or cheaper, and is liquidity becoming more abundant or scarcer? When rates rise or liquidity is withdrawn, the most immediate impact often shows up in currency and risk asset valuations. Credit tightening and demand cooling follow, and inflation usually moves last. Start with inflation. Academic research generally finds that monetary policy takes time to pass through to inflation, and the sensitivity changes across eras. Studies suggest that before 1985, policy had a more direct effect on inflation, while after 1985 the transmission became slower, partly because the economy changed, services became a larger share, financing became more diverse, and household balance sheets became more complex. So when you see hikes, do not expect inflation to turn the next day. Often it takes months, and sometimes it takes a year to a year and a half. Next is the exchange rate. IMF research suggests QE and QT can affect the exchange rate more directly and more strongly than hikes and cuts, because QE changes the relative money supply between economies. A simple way to think about it is that QE increases dollar supply and can weaken the dollar, while QT reduces dollar supply and can strengthen the dollar. Exchange rates often reflect a tug-of-war between central bank stances. Third is asset pricing. Research and market evidence suggest the yield curve links with equities, gold, and commodities. When the curve is normal, money flows between stocks and bonds more smoothly. When the curve inverts, risk appetite often falls. Historically, the 6 to 12 months after an inversion have often been a tougher period for equities, because an inversion implies weaker growth expectations and pressure on future earnings. Gold depends more on real rates. If QE pushes nominal yields down while inflation remains, real rates can turn negative, and gold tends to look more attractive. Fourth is credit. Research finds that the speed and strength of transmission into credit markets depends on loan type and maturity. Loans tied to short-term rates, like many floating-rate mortgages, react more strongly to policy changes. Loans tied to long-term rates, like fixed-rate mortgages, react more slowly. This matters a lot in Europe because many euro area mortgages are floating, so hikes hit monthly payments more directly. In the US, 30-year fixed mortgages are more common, so even when the Fed hikes aggressively, many households do not feel the impact on existing mortgages immediately, and that is part of why the US economy can appear more resilient. A 2019 analysis argued that Europe's banking system recovered more slowly after the financial crisis, which can weaken policy transmission compared with the US. US bank equities recovered earlier, while European bank equities stayed depressed for longer. One reason is that European QE bought more government bonds and stabilized public financing, while bank profitability was squeezed and bad debt pressures were harder to clear. So when you evaluate policy in Europe, it is not enough to watch what the ECB does. You also need to watch whether banks can, and whether they want to, pass policy through to the real economy. We also need to separate the US and Europe at the structural level. In the US, inflation pressure has often been driven more by strong domestic demand. In Europe, pressure has often been tied more to supply constraints, especially supply chains and energy structure. There is also a development worth watching. The US curve has been inverted for a long time, and recently it has flattened, which makes it look like the inversion may end. Historically, the most dangerous moment is often not during the inversion, but when the curve re-steepens and turns positive. The reason is that a return to a positive curve can mean the central bank is responding to rising economic stress and the short end may be pushed down quickly to fight downside risk. So when you see the inversion fading, do not treat it as the alarm turning off. Ask whether risk is disappearing, or whether the market is pricing the moment when risk finally shows up. In Europe, and especially in Germany as the manufacturing core, high rates combined with energy cost volatility have already compressed profit margins. If the US and Europe both move into a curve normalization phase, it can be a sign the cycle is turning and asset pricing is entering a new regime. Let's bring today's points together. First, an inversion is a warning signal, and the end of an inversion often means change is beginning to show up, so this is a phase where strategy should be more cautious and margins of safety should be larger. Second, QE and QT are the central bank's breathing mechanism for market temperature. From crisis backstops to balance sheet repair, reading the direction of liquidity helps you time allocation shifts. Third, whether it is euro area coordination or Hungary's independent defense, the lesson is the same. In complex environments, managing liquidity and recognizing risk often matters more than chasing yield. If you understand the logic behind monetary policy, it becomes much easier to stay rational through volatile cycles. If this episode helped you build your framework, please share it and subscribe, and in the next episode we will keep breaking down how financial markets actually work.